Good weekend, all. Ira Epstein, and here we are with your financial market weekend edition for this Sunday, Super Bowl day in America, February 9th, 2025. All right, interesting week. Not a lot happening over the weekend that we have to worry about. But as you know, the markets were set on end on Friday. A couple of events took place. We saw the U.S. non-farm payrolls, and we saw that wage inflation was going up. We saw a big revision to the December number, up 51,000 jobs, while you didn't hit the estimate of 170,000 jobs coming in the 140s. But the overall part, well, you've got a problem there because you're still looking at wage inflation. Fed Chair Powell is going to testify Tuesday and Wednesday in his semi-annual talks to both the House of Representatives and the U.S. Senate. He's going to be questioned on interest rates. And what could he say other than what he has been saying? We've hit a sticky part. Inflation numbers aren't falling. We're seeing that the market is anticipating that core CPI is going to stay in the 3% plus area, and that the Fed isn't in a position, given that and the strength in the labor market, to at this time cut interest rates. But the economy is strong. Employment is sound. No need for the Fed to tinker at this point in time. I'm sure a number of the different members of Congress will argue with that, but that is about all that he can say. When you and I take a look on a monthly basis where we're at, the market isn't going anywhere. It's down 0.29% for the month so far. When we take a look at a weekly area chart of only closes, same thing. So we're looking in the first 9 days, calendar days of the month. Maybe we get back into the 18-week average of closes for support. You can see how the market is just about now going sideways. And you see that when you put the swing line study in. This is that chart without the swing line. The swing line connects the prior bar in a very specific way. I teach this in my charting course. You've got, though, a higher high and a lower low. That is not a trend. Uptrends are higher lows, higher highs. Downtrend, lower lows, lower highs. You don't have that pattern. What you do have a pattern is a market continuing to hit and fight a battle at what I call the line in the sand, which is the 18-day average of closes, the center ground for the market. The resistance point has been and continues to be the upper Bollinger Band. If you haven't learned Bollinger Bands, I'm going to talk about it at the end of this. It's one of my absolute favorite tools in trading. And the reason is you can look on the charts till you're blue in the face trying to find out, why did the market stop at that number, up or on the downside? And if you don't have this tool, you start learning that without it, you've got your hands behind your back. Very important to see what it does. It's as important as I feel of learning where a neutral point is on a chart. And in momentum, you see you're overbought. So in summation, you have an overbought market that's churning sideways, fighting higher interest rates, and fighting what Trump said would be a rash of new tariffs, reciprocal ones, that he's about to put on this week. What that means, you know as much as I do at this point. We can see in the Dow that you've gone here and you, again, don't have a trading pattern. You have the lower low and then a higher high. You really haven't been hitting the Bollinger Band. I wouldn't be surprised that you fall back to the 43,614 area to regain, if you will, the neutral stance. You've been hitting that number. And in the NASDAQ, you're actually in an uptrend. You have the pattern of higher lows, higher highs. You are in overbought territory. I define overbought anytime a slow stochastic has one of the legs of the numbers over 70. Got it? So when that happens, it's one of the filters I use that says, maybe you shouldn't, Ira, be telling people to deploy new money in the market. It either embeds where you lock in both the numbers over the 70, actually the 80 level, or it does what we often do. We get up to that number and we waffle a bit as you're overbought. Could it re-embed? Absolutely. But why should it right now? That's the problem that I have. I have an all-out sell signal in the Russell as long as the market does not get back over this week's high. I think the pros will take a hard look at it at the 2303.50 area, saying that is the resistance point, and the objective might be the lower Bollinger Band at 2154. In the 5-year notes, we had a bounce this week that went up to what I call that line in the sand, and it halted itself. So we had what we can call here a market that stepped out of a downtrend. It had had lower highs, lower lows, had a relief rally, which dropped interest rates, and now it's sort of stalled out. 10-year note did the identical thing. When we get to the dollar index, is the market going to pull back and try to hold support at 106.56? I see nothing on the chart at this moment that says for me to get bullish. I see a market with a higher high, lower low, overbought correcting situation. It had an embedded reading that it lost. Would not surprise me that it goes back to the 18-day average, if you will, to reestablish itself and figure out what next. I just don't see a pattern here that says do anything. And in the euro, you have a higher high, lower low. The currency trade has stepped out of trends right now. That's what the weekly chart is saying. That doesn't mean the bias isn't down here and that the bias in the dollar isn't up as the market's over that key average. But it isn't saying, hey, come on in and join the party. And I think that's important. In the Canadian dollar, you went down again to the Bollinger Band, getting a rally, lost the bearish embedded reading. The odds favor price and the 18-day average are going to come together as the market tries to make a run to a neutral stance. In the Japanese yen, I don't see any reason for this to get hurt. I think that the Prime Minister's mission on Friday was accomplished. Number one, Nippon isn't going to try to buy U.S. steel. They want to invest in U.S. steel. That's a way around all this. Why wouldn't you allow that to happen? Any shareholder anywhere can buy shares in a company, so invest in the company. That makes sense. Then you heard him talking about Toyota and other companies. They're opening up their $14 billion EV plant, which builds the batteries in Georgia. That's happening. And all the other monies that he's willing to do. Smart move on his part. Don't know what the president will say with Japan. They have a 68, I think, $billion trade deficit with the U.S. Not a fortune. Let's see what happens there and how he treats them. It could be favorable. Lower highs, lower lows, still in a downtrend, but the market's over the 18-week average of closes. The next resistance point, the combination, which is going to fall fast. The Bollinger Band's going to slip down under the current configuration. And it'll be between that and the 100-day average if it can continue to rally. In Bitcoin, I've been looking for the market to back off towards the 18-week average, and I've got what I want. So I see a neutral market here. Notice we don't have a lot of clear-cut trends. I think the only clear one, doesn't mean it'll stay that way, has been the Russell 2000. Let me come back here. As you look at the Brent versus WTI, it is settled in at the differential of 366, 367, the 18-week average of closes. You pulled back from the 100-day average in the upper Bollinger Band. I teach this over and over. You hear me mention it to you all the time, how to play with this. And when you did that, now you're back to the neutral zone, the 18-week average. You have the trend up, the bias down, not much going on there. Same type of play? Not quite. You've got an actual downtrend in WTI. Lower highs, lower lows, and the market settled underneath the 18-week average. The trend is down until you take out the current week, last week's high. And until that is done, I can open up the door saying maybe the market makes a run to the lower band of 65.5. In the gasoline market, the trend is up, but you're caught in the narrowness of these Bollinger Bands. Whenever I see that, I run away because the market often is the type of market, and the word is all I could use is often, that until it breaks out one way or the other, you get stepped on. In other words, you think it's going to break out. It doesn't. It keeps pulling back on you. So you put that together, you come up with a game plan. And again, what I'm telling you is enhanced Bollinger Bands. If I had to teach people two things how to work, momentum, the slow stochastics, and the enhanced Bollinger Band all together in my course. And in this course, I told you how to work with the two from my point of view, show it to you on the charts. And with the course, you get to come in my morning videos and see me apply it with charts that are current at that moment. So I think it really shows you what I'm looking for. Let's assume you don't like it. You learn a tool. Let's assume you like it. It adds to your arsenal. So you get the 14-day free trial. You get our charting software if you haven't tried it. All this together, inexpensive. You go to iraepstein.com. Under the word education, you can move your cursor to the top here. That'll take you there as well. With that, I'm Ira. You have yourself a great weekend. Good Super Bowl. It's going to be an exciting one, I hope. I'm Ira. I'll catch up with you first thing in the morning. Take care.